Hello, I'm Alan Kohler, founder of Eureka Report, which is now part of Intelligent Investor, finance presenter and columnist for the ABC.
And I'm James Thomson, senior Chanticleer columnist at the Financial Review.
And we are the Money Café.
Hey.
Now, James, you had an interesting piece yesterday from quoting a note from George Tharidu of UBS, talking about the wealth in Australians now. And Australians individually, on average, are the fifth wealthiest people in the world.
Yeah. It's quite the boom in wealth that we've seen. We are now worth $18.1 trillion. That's grown 7.7% year on year to the end of the September quarter. Which
is mainly due to housing, right?
Housing and super. Your big equity returns in super is also helping asset price appreciation in our super funds. We have the eighth most US dollar millionaires in the world, despite being what are we, under 2% of the global market. So pretty amazing. Average wealth $654,000. But look, the point of this is, the point of George's note is that we're sort of seeing a bifurcated economy now between those who have wealth, and particularly older households who are not only benefiting from this rise in wealth, but this massive jump in income from retirement savings, which is now worth about 11% of annual household income. So the amount of retirement benefits in the last year has jumped 10% to $192 billion. That is an incredible amount of money. And Theranow's point is this is sort of changing the economy. It's changing how and where spending comes from. Obviously, it's being generated from older households. It's changing the wealth transfer, the sort of intergenerational wealth transfer. So inheritances are basically being pulled forward through financial assistance for families to either get into housing or for living expenses. That's the one that got me. 20% of UBS did a survey. 20% of people were providing financial assistance to their families, and the bulk of that's for just living expenses. So, this is a sort of change.
Yeah, and you also related to the superannuation tax, because you're saying that really this is going to be where the governments look to increase their incomes from, tax incomes.
I think that's right, but I think there's sort of two parts to that. This is the big honeypot, and politicians are always attracted to honeypots, particularly when it's someone else's money. But I think B, it comes back to this inequality question for me, Alan. Like, you're going to have a growing cohort of younger voters who feel very angry about being locked out of housing, struggling with their spending, while older Australians who happen to be sort of born at the right time and worked very hard, of course, are doing much better. So I think that political pressure from younger voters is going to force politicians to act in some way so the burden of the taxation burden, the income taxation burden, doesn't fall disproportionately on a sort of smaller pool of younger workers.
But Jim Chalmers has backed off the tax on unrealised gains. I mean, if you're really going to go after a baby boomer wealth, you have to tax unrealised gains, I guess, because
I guess, Alan,
they're mostly being unrealised. But that's really a step too far at this point, anyway.
Yeah, and so what he's done is he's hit very wealthy superannuants even harder, and then increased the sort of tax on those with, or the reduce the tax break, as I know you have pointed out before, on realised gains. So I don't know. I find this one interesting. Obviously, there's this sort of sentiment that Chalmers has backed down and he's been rolled by the Prime Minister. And I guess that's right. But he's sort of got to the same point through other methods, hasn't he?
Well, one of your colleagues on the Financial Review suggested, I can't remember who that was, suggested that it's really just a bait and switch.
Yeah.
He's done what Trump does, which is to announce something really extreme and then announce something less extreme, and everyone goes, "Oh, that's great."
Yeah. What do you make of that argument?
Oh, yeah, I think that could be true. It could be true. Look, I mean, I haven't spoken to Jim Chalmers about that, so it's hard to imagine. He would never admit to that anyway.
No, no.
But,
But although he did say, as he sort of announced this change, that we've just got there by another method. And I think I just wonder if that's the thing we should take out of this going forward. Okay, he didn't do the unrealised gains, seen as a back down by some. Fair enough.
yeah, no one's going to worry about 40% tax on $10 million superannuation balances, are they?
I guess that's my point. Politicians of the future are going to find the path of least resistance to whacking. They're going to have to go after wealth in some form. Okay, they'll find the path of least resistance to do it. But the point is, they're still whacking wealth. That'd be my sort of zoomed out takeaway.
Yeah. No, I think that's a pretty good takeaway. And the other graph that George Tharineau had in his thing was mortgage costs as a percentage of income come down a bit, obviously, in the last 12 months with 3 rate cuts, but still near a record high and certainly above previous peaks.
Yeah,
still.
yeah. I mean, yeah, and I think that comes back to my point about that. You know, the gap between different households. I just find that juxtaposition that this data shows quite extraordinary. Like, one of the richest countries in the world, wealth booming, and yet lots of those wealthy people have to give money to the younger members of their family to keep them afloat.
The
There's
chart
something not quite right there.
The chart that you had in your piece showing family assistance provided to family percentage share of responses, and the largest share of responses was for living expenses.
Yeah.
I mean,
and I would imagine, Alan, that includes stuff like school fees. So, but yeah, I just I don't know. There's something wrong with that picture.
I know. I agree. It's
and I think if you're a politician looking at that, you're thinking, geez, how do we close that gap? Otherwise, we're going to have two. You know, the bulk of the electorate is going to be very angry with us very quickly.
I mean, the other way to look at it is there's nothing particularly wrong with early inheritance. I mean, as long as the providers of it don't leave themselves too short because they live longer than they expected.
Yeah,
I mean, that's the other dynamic going on, is that we're all living longer. People are going into their 90s, and possibly everyone's kind of possibly people are saying, you can have this much of my super and my retirement savings to their kids on the expectations they'll die before they're 90, but they end up living till they're 100 and they'll run out of money.
Yeah. Well, I guess the kids have to make sure that the house they build with mum and dad's money has an extra room.
Well, there's that, of course. Otherwise, the money just has to go back the other way, I guess.
Yeah, yeah. You know, I mean, I guess, Alan, you know, the people living to their 90s will still enjoy over the next X number of years a degree of asset price inflation based on recent history. So maybe they're just making the bet, well, it'll all work itself out. I don't know.
Yeah. So what do we make of Donald Trump and what's been going on the last little while?
Well, he's had a pretty big victory in the Middle East, hasn't he? I mean, you've got to hand it to him in some ways. He's done what didn't seem to be possible and got these hostages free. I'm not sure if there's going to be a lasting peace there, but it's quite the breakthrough. So he's entitled to a victory lap there, I would have thought.
Yeah, I mean, look, I totally agree. But I mean, clearly Hamas was going to give up anyway. I mean, they were completely buggered, I would have thought.
Yeah,
so,
perhaps.
I mean,
perhaps.
So it was ready. It was going to happen. He just managed to swoop in and take the credit, which is good for him. But I just think the other thing that's been the markets have been all about is the Chinese decision or threat to restrict rare earths exports.
Yeah.
And then Trump's response to threaten 100% tariffs on China and then back off a couple of days later.
Yes.
And I suggested last night on the news that this is because he's having such a lovely time in Middle East, and he was there and feeling great, and but actually, I looked at the token price of World Liberty Financial, which is the crypto outfit that he and his family created in September 2024, and which the Trump family owns 60% of. Although Bitcoin, after Trump threatened to China, 100% tariff on China, the stock market in the US fell about 3%, and Bitcoin fell 10%.
Yeah.
World Liberty Financial's token price fell 35%.
Oof.
And so I reckon that's why he backed off.
You reckon? Yeah.
Oh, yeah. That's what it is.
Well, I think, yeah.
I mean, Victor Schvetz had a note this morning, which you may not have read yet, our friend with Macquarie Bank in New York. He had a note this morning saying that this is the last remaining guardrail on Donald Trump's behaviour is what happens to crypto, and in particular World Liberty Financial. And I reckon there's something in that.
Yeah. I haven't read that note yet, but it's on my reading list. Look, I mean, I thought the whole episode on Friday night on Wall Street was really interesting, and so quickly everybody, just the psychology of how quickly everybody sort of said, well, we should have expected this. Positioning's got very extended. There's so much leverage in the system, including in these crypto coins and, ETFs that have 3 times leverage on single stocks. There's so much leverage in private credit, which is cracking. It was there's a lot of forest fuel looking for a spark, and Trump provided it. I totally get that argument, but it's fascinating to me how quickly the market has rolled back that, with a couple of calming words from Trump. But and I take your point about crypto. I think that's completely valid. He doesn't he doesn't want to bash that market unnecessarily, or doesn't seem to want to. The thing that gets me, Alan, is that the tensions between the US and China are still escalated. That rare earths edict from China is still in place. We've seen some very strange things with the Dutch government taking control of a Chinese company. Then China has launched overnight a bunch on Tuesday night some probes into US shipping businesses in South Korea. I mean, I don't think this sort of back and forth between China and the US has calmed down, and the sort of tariff story doesn't seem over to me. But it's remarkable how quickly the market just decides, yep, don't worry about it, just keep buying.
So I've been reading stuff lately, been coming out of Wall Street in the US that there's going to be a melt up, that we're in.
Yeah.
I mean, I remember
big
back
run
in
into the end of the year.
Yeah, well, you remember, what was it, 2000, around about the year 2000 or something, Alan Greenspan was talking about irrational exuberance, and the market still had 5 years of run left in it.
Yeah.
And I also remember back in 1986, people were saying the market is overvalued, it's going to crash, and between then and October 87, it doubled. So the market often, even when you think it's too high and it's overextended, it often keeps going.
Yeah.
And
in the final stages before something happens, it can often be the most profitable bit, right?
Well, that's it. That's the thing. I mean, yeah. So it's a terrifying time, really, to be honest, for investors. Terrifying because you know that you could miss out on a bit. You could miss out on another 100% gain. But then again, you've got no idea when the thing's going to crack. And the trouble with this current bubble is that it's supported by profits. So it's really an earnings bubble rather than a price bubble. And
Yeah.
the question is, when are the earnings going to come to an end? And that can take a lot longer than a price bubble.
Yeah, that's a good point. There are
Yes.
some amazing things going on in AI, though. Like, I don't know if you've been tracking these deals that OpenAI has been doing.
Yeah, I have.
So, that they just did one this week with Broadcom. And they've done one with AMD, and they've done one with NVIDIA in the last month. So these are all the big makers of artificial intelligence computer chips. And so OpenAI has done deals with them, very large deals, no details around them. But and essentially OpenAI has promised to buy chips from these guys over the next decade or so as they try and, build data centers and build up their business, which is all good and well. But OpenAI doesn't have any money. I mean, the thing is worth $500 billion on paper. It has shown it can raise money when it needs to, which is, all good and well. But its revenue is something like $12 billion US, and its annual losses are running at something like $10 billion US. But I think, Alan, they've, that old sort of saying that when you owe the bank $5,000, it's your problem. When you owe the bank $5 million, it's the bank's problem. I reckon OpenAI has created that sort of vibe in the tech world. If it turns out that OpenAI was to fail or go bust, then what do the big chip makers do? They've just lost their most important customer. Do you think they have to step in and bail OpenAI out, or do they or when OpenAI comes rattling the tin to raise debt or equity, they won't be the first in line? I think it's a fascinating sort of.
I agree. I mean, I've got a graph for the ABC News tonight, which I saw on Axios this morning, which shows that the number of articles written online, so a number of internet just simply the broad number of articles that are being written by AI rather than human beings is now above the number that are written by human beings.
Oh gosh,
it's gone to 52% versus 48% by human beings, and the big increase started when ChatGPT was launched by OpenAI. So people are using this. I mean, I use it every day. ChatGPT. I think it's incredibly good. It's amazing. I mean, ChatGPT is amazing. What's not happening is I'm not seeing any ads yet.
No. And that is the question, the monetization question. I mean, are you paying, Alan? Are you a paid user?
Yeah, I think I am, yeah. I mean, I suppose that's the point, I suppose.
Yeah, well, that is the point, but there's not many of you
who
actually pay. They're mainly enterprise users, and there's not enough of those to make this work, I don't think. So anyway, yeah.
We probably should move on to questions. So before we do that, let's hear a quick word from our sponsor.
When it comes to investing ethically, you shouldn't have to compromise on returns. The Intelligent Investor Ethical Share Fund is built on that belief. It combines ethical screening with disciplined value investing to uncover high-quality, responsible companies in Australia and overseas. The result? A fund that's delivered strong performance while staying true to its principles. Though, as always, past performance isn't a guarantee of future returns. For a limited time, you can invest in the fund with zero brokerage fees directly through Intelligent Investor. Head to offer.intelligentinvestor.com.au/INES to read the offer conditions and see if the fund's right for you.
Okay, first question's from James. My question is, what should apartment owners do given the following? The energy transition is already dividing Australians into two energy classes. Detached homeowners with rooftop solar, batteries and EVs are becoming self-sufficient micro-generators. Renters and apartment dwellers lacking both roof access and capital remain fully dependent on the grid. Because network and environment charges are recovered per kilowatt hour as solar households draw less power, those fixed costs are spread over fewer customers, and so on. So he goes on, but I think that's kind of the inequality he's talking about. I think the grid is now 50% renewable. In fact, if you go onto you or the listeners go onto the AEMO website, the Australian Energy Market Operator, and you can. It's probably best to just Google National Energy Market, and then go to the dashboard. You can see on that what the energy mix, the fuel mix is of the grid. And you can also see a graph, which I'm thinking of putting on the news tonight, of the wholesale price of electricity during the course of the day. And between 9 and 5, in each state, it's negative. The wholesale price of power during the day now in Australia is negative.
Yeah, right.
It's amazing. It's because when the sun's shining, there's so much rooftop solar that basically businesses are getting paid to use energy.
But not renters.
That's right.
To James.
Not renters. So that's right. I mean, but look, it is getting the percentage of renewables in the grid is rising pretty quickly, but it's not obviously not yet 100%.
Yeah, and it's not necessarily spread evenly, to James's point. David says, I can see Gun-Shy Elbow has reacted to the noisy News Corp peanut gallery and backed down at the first hurdle of meaningful tax reform, diluting the $3 million super tax reform that he had an overwhelming mandate to fully implement. What hope is there for real tax reform to redress intergenerational tax inequality when he squibbed the easy one?
Well, we dealt with that in our preamble discussion, didn't we, a bit?
Yeah, we did.
He's going to be quite courageous. It'll be a courageous government that really tackles this eventually and taxes the boomers. And I suppose it'll require a bit more of a bit more of a lean towards among the voters between those who are losing out and those who are winning.
Yeah, I think that's exactly right. It is hard, but I must say, just more broadly to David's point, do you remember the Economic Reform Roundtable, Alan? Where's all the momentum from that gone?
Yeah, it's gone.
It's just gone. Totally gone. Such a disappointment.
It's been completely drained by the Prime Minister who doesn't want to do anything.
Yeah. I think, it's disappointing.
Yes, we're disappointed. Okay. Ian says, I've recently started using AI to pick the bones out of company reports. It has been useful in finding, for example, timelines for projects, cash flows, etc. Is this something you do yourselves? What are other better ways? What are some better ways, better questions to be asking our new overlords? Right. I mean, I have
done a bit of it. Yes.
Have you done that?
Yeah, we've stuck some company reports in there. This is, I think you had Alan, you've referred to a few times to the guy who's building the prompt library.
Yep.
And that does really strike me the more I use AI, like the quality of your prompts, and there is a skill to knowing how to get the most out of it. And Ian, I'm not sure I have any great advice for you. I think you just got to keep using trial and error to try and, I mean, the sort of most common way I've been using is to summarize big reports. You know, what are any key patterns, any key trends, any key points out of this?
Yeah.
And I sort of sometimes think, I don't know, it's hard to judge how well the technology is performing. So yeah, I think it's trial and error, Ian. We're in the if you get on Twitter, you can find, or X or whatever it's called, there are lots of people who do a lot of talking about prompts. And that might be a way to just try and...
I did a prompt yesterday. The prompt was, someone asked me a question you might know the answer to, or at least have a thought about. If rare earths are so important, why haven't we been mining enough of them for years already instead of letting China get control? And the reply was, that's a very sharp question. And the answer combines geology, economics, environmental regulation, and geopolitics. And it went on. It was a fantastic answer. It was so complete. It just was good. And then it offered a timeline showing how China got control of the rare earth supply chain in the world between 1970 and now. Yeah. And then I said, okay, yeah, give me the timeline. And then it gave me the timeline. It was just fantastic.
Oh, there you go. There you go. Very impressive. So, yeah, keep playing, Ian. I'm going to jump to this question from Nicole, who Says her question's more a request for discussion and to highlight a forgotten issue around first home buyers.
It's long, though. You're not going to read it all out, are you?
No, I'm not. But her point is that it's not just being able to buy a house; it's being able to service a loan that is that is the most important question for many borrowers. So being able to get the deposit, even with some help from the bank of mum and dad, being able to get into the market's one thing, but it is the loan serviceability equation that is the most difficult. She also says middle income housing market has evaporated, e.g. 2 to 3 bedroom houses or apartments in an outer city location, as that's what the majority can afford. This used to be considered a starter property or a sacrifice you make to get in, but you can't even get into this segment anymore. Nicole says she's frustrated with the government ignoring this group, which includes me. Everyone knows it is a supply issue driving the housing crisis. There's some minor government effort on increasing supply, but is mostly focused on social housing and low incomes. Middle income earners, who are the majority of people, don't meet social support requirements. And it's just, sorry, it's just worth reading this.
No, I think it's true. That's really.
At age 35 this year, I've literally given up on buying property as there's no amount of money that I can earn which will afford me a house as a single person. If I seek a job that earns more than $250,000, it's high pressure, long hours, and half of it is taken in tax anyway. That is, Alan. That equation is, I think, that is what politicians should be freaking out about.
Yeah, I agree. And I don't think it's going to improve. I think that the housing accord was signed in 2022. October 2022 for 1 million houses over 5 years. That's what they agreed on. And then the government upped it to 1.2 million the following year. And the people who signed that housing accord back in 2022 were all governments in Australia, every single government, including local governments, 9 super funds, and the entire housing industry. They all signed up to that. And I calculated, and I had this on in my column in the ABC, that since then, population growth has been, this is just since then, this is 3 years, population growth has been 1.7 million. The number of houses built has been 500,000. And if you look at the number of people per house, apply the standard number of people per house, that's a shortfall in those 3 years of 200,000.
Right.
Now, I mean, you could say, okay, well, the 5 years has only just got going, but the housing approvals are falling.
Yeah.
I mean, in August, housing approvals fell 6%. I mean, they're just not getting anywhere at this point. I mean, and the other thing is that the New South Wales and Victorian governments are completely trying to, at least, completely reshape the suburbs. With their densification plans, which is the whole plan, really. Basically, the whole plan is to densify Australia's suburbs.
Yeah. Which
is fair enough. Okay, do that. But the trouble is, there simply aren't enough tradies.
Yeah.
To build the houses. I mean, they can raise the height limits all they want around stations, which is what they're doing. But if you haven't got enough of a construction industry to build the houses, it won't happen, and they haven't. They simply haven't, and they're trying to get more apprentices, but the number of apprentices is declining.
Yes,
and they're not getting, and the number of immigrants who have construction skills is also not increasing. So they don't have a plan to increase the number of tradies who can build the houses.
Why? I don't know. We might be taking up too much, but why do you think we haven't reshaped the migration program to really focus on construction skills, for example? I mean, if you think about so many things in the economy, they rely on construction skills, infrastructure projects, renewables rollout, mining and energy more broadly, and of course housing.
Because the government doesn't actually control it. I mean, they have a skilled immigration program of 185,000, but that's nowhere near even half the number of immigrants that are coming in, and the skilled migration program is only a small proportion of that is construction. And they basically outsourced. The government has outsourced immigration to the universities. So they've actually increased the number of universities in Australia that can bring in foreign students to 15 from 8. And there's now 15 universities in Australia that have commission agents scattered around Asia and the rest of the world who are recruiting students for these universities on commission. And the number of these students who move to permanent residency is more than double what the government thinks it is. The Treasury's estimate of students moving to permanent residency is 16%, but actually it's 40%.
Wow.
And so the thing is, not only does the government not control immigration really, they've got no idea what's going on actually.
Wow. So we've really got to.
They don't know what's going on, which is, I find, incredible.
So really, the only thing we can offer Nicole at the moment is sympathy.
I'm afraid so.
Yeah.
A question from Anonymous. How do you think the proposed class action over vitamin B6 toxicity could impact Blackmores brand value and share price, given its reputation as Australia's supplement success story? Could it be the end of for health and supplement industries locally and abroad, as the case was to progress and found guilty of something?
Oh, the good news, Alan, is we don't need to worry about Blackmore's share price because they were taken private in 2023 by Kirin, the big Japanese drinks maker.
That's right.
So that's one thing not to worry about. I confess I haven't heard about this case.
Let me read you a bit of the it's Polaris lawyers who are trying to drum up a class action.
Right.
And this is what they said. Their client is Dominic Noonan O'Keefe. In May 2023, he bought and started taking Blackmore's vitamin supplements to maintain his health in anticipation of the birth of his first child on 26th of May 2023. He was unaware that the Blackmore's Super Magnesium Plus and Ashwagandha Plus he was taking contained potentially toxic levels of vitamin B6 and could not have imagined the significant long-term problems. He started experiencing significant fatigue, excruciating headaches and hypersensitivity to his environment. He found that the Magnesium Plus he was taking contained approximately 29 times the recommended daily intake of vitamin B6.
Yikes.
Yeah.
Well, so, I confess I didn't know about this. Yeah,
I didn't either. No, but there you go.
If it's
it hasn't. It's not a class action yet. They're still trying to drum it up.
Yeah, right. Well, I guess look, if there was a class action and it was to go through the courts and be heard, there would be an impact on supplements. Although I imagine there'd be concerns about individual supplements. I imagine that Therapeutic Goods Association, Therapeutic Goods Authority might would have to get involved in some way. So fair way down the track, but it wouldn't be good for the supplement business, that's for sure.
It certainly wouldn't be good for the sales of Magnesium Plus.
No. There you go.
You'd imagine.
Now, I think we referred to this question before from Mark from Sweden, who says, love the Money Café podcast. I've been listening for 2 years. If rare earths are so important, why haven't we been mining enough of them for years already?
A big part of the answer, apparently, according to ChatGPT, is environmental. It's the mining of rare earths is very toxic, apparently, and China went for it big time and didn't care about the environmental impacts, and so there's large parts of southern China that are uninhabitable now. Apparently, I don't know. I mean. So that's one reason. The other is that the biggest rare earth supplier was a mine in the United States, which started in 1949. But when China went for it, it simply drove that business out of business. That mine just went out of business, closed.
Yeah.
Because they couldn't keep up. Because China was basically underpricing. It was dumping rare earths for the first sort of couple of decades of its plan. It was a deliberate plan to take control of the rare earths industry, and it basically dumped it to drive everyone else out of business, which basically happened. And what didn't happen is that governments other than China saw the importance of it and propped up their own companies. So the companies all either closed or went bust, and the governments didn't prop them up. And China's government basically had a long-term plan to take control of the industry, and there you go. That's what happened.
Yeah, I think the other part to think about, Mark, is that rare earths aren't exactly rare. It's just that the refining capability is very concentrated in China.
And it's hard. It's not easy.
Yeah, so that China has gripped the market by really being able to control the refining and production of the end product, which is so important.
Luke says, I'm 40 years old and have been using a financial advisor to invest my super, approximately $300,000. This has involved investing in ASX shares. Due to the high cost of the financial advisor, I've recently ended the engagement, and now I need to identify a fund to invest in. I'm tying myself in knots trying to choose the best option. How do you choose when past performance isn't an indicator of future performance? Good question, Luke.
Great
and
question, Luke.
You certainly didn't need a financial advisor when you're just investing $300,000 in ASX shares, that's for sure.
Yeah.
So it's probably not worth having a self-managed super fund either. That sort of money, it'll be too expensive.
And that would be my question, Alan. Is Luke's best bet? And again, we're not giving personal advice; we're giving general advice here. But is the best bet of someone in Luke's circumstances to move back towards the mainstream super sector?
Absolutely.
Where your money will be managed not just in Australian shares, but in global shares and a range of asset classes. It'll be managed by lots of different managers, so you don't have to go through the pain of picking one, and it will be managed in the most tax-effective way.
Yeah, and you might get cheap life insurance as well. Just pick a big super fund. It's true that past performance is not a guide to future performance, but basically it's all you've got. And past performance does at least tell you whether the outfit knows what they're doing. And if they've had good performance in the past, then they're probably okay at it.
Yeah. I did see a stat the other day, Alan. I think it was out of Jefferies. It said 22% of fund managers around the world are beating their benchmark this year. So, there's something to be said for getting into a big fat super fund and basically trying to hug the index as they effectively do these days.
Well, the other thing is super funds are also investing in a wide range of different things, including infrastructure. I've been writing up Host Plus lately. That's put a fair bit of investment in a fusion energy business in the US, $330 million, because Sam Cecilia, the chief investment officer of Host Plus, happens to have a PhD in theoretical physics. And he's excited by fusion energy, so he's invested in it.
There you go.
But he reckons this company they've invested in will be a $1 trillion company in 5 years, in which case their 5% of the business will be worth $200 million, and will be their entire fund at the moment is $200 million. So if that's true, they'll double their fund.
Yeah.
I mean, look, I don't know, but the thing about these super funds are all investing in airports and different things that you can't get access to on the share market.
Yeah.
And
or as an individual investor. Yeah.
Yeah.
Terry says, I just had emergency shoulder surgery. Sorry to hear that, Terry. And I've learnt how much insurers appear to be profiting from a broken health system. I pay about $5,000 a year for insurance, yet I still paid $400 for surgery consult, $500 for a surgeon fee, $500 to the anaesthetist, $750 for hospital excess, and even got billed $160 for an X-ray during surgery. Why? Because the X-ray is considered another doctor's expense instead of a hospital ancillary expense. The crazy part, Medicare pays 75% of the fee, and private health insurers only have to pay 25%. Is this fee for no service?
Well, yeah. So the way it works is that if you're in private health insurance, the insurer pays your hospital stay. So they're basically paying the hotel bill, and all the things that go on in there are separately billed. So the surgery, the pathology, the radiology, everything. And the fact is that they're all on Medicare, and Medicare has not kept up with the costs of providing those services. And so there's always a gap.
Yeah.
And there's one place that there's no gap, which is the Aideney Private Hospital in Kew in Melbourne, which is half owned by Medibank Private and half owned by the doctors. And Medibank Private has done a deal with the doctors whereby they all agree to charge the Medicare rate for the extra services. So if you go into this hospital, it's all basically covered. You won't pay any extras, because the doctors have agreed to charge for their services what the Medicare rate is, basically their bulk billing. And the way they achieve that is by Medibank is agreeing to top them up, and also they're sharing in the hospital's profits. And Medicare wants to roll this out across the country.
But I presume, Alan, it's not an emergency hospital, and so
No.
is that a different issue?
That's right. But so what it is an experiment. So they're basically halfway through a 2-year period of proving the model up. And if the model works, then they're going to start, they reckon, Medibank says, they're going to start converting existing hospitals that have emergency departments, such as Epworth or Cabrini or so on. So they'll start converting those hospitals into this model. So, look, I mean, I'm excited about it. I think it's great. Good for them. But until that happens, we're all paying the gap, that's for sure.
Yeah. Good.
Because the government's Medicare item number payments didn't keep up.
Yes.
Anyway, Andrew says, last week a punter said reverse mortgages were criminal rates. The Aus government offers a 3.95% interest rate. Older people have it good again, where they can borrow 4%, invest and earn at a higher rate. Cut the woe is me. If the pension isn't squared enough, sell your house or get a reverse mortgage. It's really not that hard. Yeah, I mean, we had someone who was their parents were in a house, and they couldn't. They were living on they didn't have any super, and they were living on the pension, and they were struggling to get by.
Yeah,
and they wondered what to do, and because the guy had looked at reverse mortgages and found that the interest rates were too high. The government does have a reverse mortgage scheme, but it's pretty restrictive. I can't remember the terms of it, but it is worth looking up. It is a 4% or 3.95% rate, but it's not available to everybody.
Yeah, okay.
So and I think also the amount you can get is not that much. So but it's certainly the case that it is available through the government. Yeah.
So look at your options in that one. Yeah. All right, last one, Alan. Thomas says, a couple of weeks ago I sent an email expressing a little scepticism about the financial wizardry and opacity underlying certain aspects of the private credit markets. Since then, we've seen a couple of big collapses. First Brands and a subprime. First Brands, which is a US auto parts importer and manufacturer, and a subprime lender in the US for car loans called Tricolor. And he says, even Mr. Thomson seems to have traded his optimism for a decidedly more pessimistic outlook. I can assure you, Thomas, I'm always pessimistic. On the Australian front, ASIC's recent naughty letter to La Trobe Financial might suggest that there are a few governance issues of our own, let alone APRA's warning about bad actors in the wake of First, Guardian and Shield. Do regulators really have a handle on this stuff, or are we ignoring all the warning signs? That is a really good question. I think regulators themselves, including Joe Longo at ASIC, would say he's working pretty hard to try and get a handle on it, but they are in the early stages of understanding the size of this sector. Private credit in the US is having a bit of a moment. We've seen these two collapses. We've seen the share prices of private credit companies listed on Wall Street falling dramatically. We've seen these publicly listed US private credit vehicles called BDCs, or business development companies. Their share prices have been whacked. So there is a bit of concern about this. The one thing I'd say is that the private credit sector in Australia is very different to the private credit sector in the US. In the US, it's all about lending to companies, particularly private equity companies. In Australia, really what we're calling private credit is property lending. It's lending to developers. It's lending to mezzanine finance, lending mezzanine finance to property. I even saw, Alan, last year, a private credit opportunity flyer come across my desk. It was two two nice houses in Hawthorne, in a suburb in Melbourne, that had been stuck together and bundled up as a private credit opportunity. So Joe Longo's made this point that in Australia we need to be really careful with private credit because it's all based on property. Property prices are high. There's plenty of debt floating around the system. It is something that regulators are watching. Have they got across it, Thomas? I'm not sure, but I think investors in Australia particularly need to be really cautious about this stuff. Really do your due diligence.
And I think when you're talking about property property lending, James, you're not talking about housing mortgages. You're talking about loans to developers.
No, some of it is housing mortgages. And they're subprime. Now, I guess you call them more non-bank lending than subprime lending, but they're the stuff that the banks don't. They're the mortgages the banks don't want. That doesn't make them bad credit risks necessarily, but there is a bit more care that needs to be taken. So it is mortgages. If you look at La Trobe Financial's main private credit fund, it's a collection of mortgages, non-bank lending mortgages.
I suppose part of the issue is what we were talking about earlier with George Tharanu's piece, which is that the banks are getting enough business they want, which is
totally
very solid. Mortgage businesses, very solid mortgage business where the home to value ratio is fine, and the borrower can service the mortgage and everything's fine. They're getting absolutely run off their feet with that business, so they can afford to say no to a lot.
Yeah. I just think, to Thomas's point, this label private credit gets tossed around, and it's sort of become a catch-all phrase for stuff that's been around for a long time. And if it wasn't called private credit, lots of investors would go, "Oh, this isn't necessarily bad, but it's somewhere I need to tread more carefully."
Yeah, well, La Trobe Financial has been around for 60 years.
Yeah.
So it's not a fly-by-night outfit, that's for sure.
And they know what they're doing. ASIC slapped them around. I think ASIC was pretty aggressive. I think ASIC was trying to make a point when they sent, as Thomas says, a naughty letter to La Trobe. They just wanted to raise this issue. Private credit in Australia is really based on property. It's not private credit in the US, and we need to be watchful of it.
Just before we finish, I spoke yesterday to the CEO of Cash Converters, and they're a big subprime lender as well. And they had a problem, I think, last year. Their lending was fully funded by Westpac, and basically Westpac dumped them and said they're not going to do that anymore because they've got enough going on with housing mortgages. So poor old Cash Converters had to run off to someone in the US, a hedge fund in the US, to provide their funding.
Well, but that was cheap.
Which is, well, no, that's right. It absolutely shot their margins to bits because the cost of funds is so much higher. But that's an interesting business, Cash Converters, by the way.
Yeah, there you go.
Okay, that's it. Thanks very much for listening to today's episode. Thanks, James, for your company. As always, it's been great. I'll be back next week with Stephen Main. Send in your questions to the Money Café at eurekareport.com.au. Until then, I'm Alan Kohler, founder of Eureka Report, which is part of Intelligent Investor and also a bloke on the ABC.
And I'm James Thomson, senior Chanticleer columnist at the Australian Financial Review.